Hello and welcome. Thank you all so much for joining us. This is Tax Prep for Small Business Owners. My name is Clara Shook. I am the event coordinator with the West Business Development Center. This webinar is brought to you by the West Business Development Center. We are a nonprofit funded by the Small Business Administration, the SBA, a federal organization, and we host two centers. We host the Women's Business Center and we host the Small Business Development Center for Mendocino and Lake County. Now, West is funded through federal, California state, and local government grants. In exchange for these grants, we provide free confidential business services. Our goal is to offer these business services to small business owners and entrepreneurs during every stage of business development. So whether you're just starting out with a hobby, part-time job that you'd like to turn into a full-time business, or you've been in business for many, many years, we want to be a resource that you can call upon to get help with your business when you have any questions or needs. Now, how do we do this? We do this through no-cost one-on-one counseling. So if you have a question or experiencing an issue with your business, you can speak one-on-one with an advisor because no one business is exactly the same. And so we want to be able to help you with your individual business needs. We also offer low-cost workshops and free webinars like the one you're at today, as well as loan packets and loan advising. So if you're getting ready to apply for a small business loan or you have questions about a small business loan, in particular, I'm thinking about folks who may have taken out a EIDL or a PPP loan. We have advisors who can help answer those individual questions. And that's basically how our funding is used and what we do. So if you'd like to learn more about becoming a client, I highly recommend that you reach out and either give our office a call or visit us on our website, and we can help you there. Just really quick before I pass things off to our amazing instructor today, I am going to read out this disclaimer. Since this is a tax prep workshop, we want to make sure there are no gray areas, no confusion. So this information, the information provided in this webinar and any supplementary materials provided to registrants are intended for educational and informative purposes only and does not constitute professional, financial, or legal advice. No registrant should act or fail to act on the basis of any information contained in this webinar without obtaining proper financial, legal, or other professional advice specific to their situation. The Northern California Small Business Development Center and its host, the HSU Sponsored Program Foundation, Heavenly Taxes, and Joe Dorko specifically disclaim any liability, loss, risk, or personal or otherwise, which has incurred as a consequence directly or indirectly of the use and application of the information presented in this webinar. Oh, that was a long breath. So without further ado, I'm going to pass things off to our instructor and presenter today, Joe Dorko. Please take it away.
Good morning, everybody. My name's Joe Dorko. I'm with Shasta Cascade SBDC. I'm also the owner of Heavenly Taxes, a business consulting. I've been a business owner for 34 years. I have a lot of lending experience, and I also have an extensive background in tax planning and tax prep. So, Claire, if we go to the next slide. Okay, so I want to start today, and this is kind of the focus basically of this seminar is really tracking your income and your expenses. That for small businesses seems to be some of the toughest challenges that we find today. And the importance of doing this, it's really important to track that and make sure you keep your receipts. So, it also helps you to gauge whether your business is profitable. And it allows you to make adjustments, as soon as possible if you need to. If your profit's down, maybe you need to change how you're doing things instead of waiting to the end of the year to change that for the next year. So like that's one of the reasons we're going to track our income and expenses. It also assists in financial institutions, investors in making loans, funding decisions, and also kind of one of the things that I really think is important. It helps you know how much you're going to have to pay in taxes. So it's good for planning there. So if we could go to the next slide. Okay, so ways to track your income and expenses, your profit and loss. Um, so there's certain things to think about before you set up your books. How complex is your business is going to determine how complex your bookkeeping will be. Um, will you have employees or not? What forms of payment will be accepted? Will sales be immediate or require delayed payment? Are you sending out invoices? Do you need a bookkeeping software to start? Um, Potentially you would, or you could do the traditional paper, or you could use the QuickBooks, which a lot of businesses use. But if you're somewhere in between, Excel is a good sheet also to work with. We could go to the next slide. So simple bookkeeping and tracking. It's simple to use Excel spreadsheets. You can use Google Sheets, the traditional paper, with the journal entries and T accounts, or you could use the QuickBooks Online. QuickBooks Online is a pretty simple program to use once you kind of get the basics down with it. And there's a lot of add-ons that really help make you much more efficient. But if you're just starting out, your business, you could use an Excel sheet, a spreadsheet, and save, $500-600 a year in the fees for QuickBooks, or you can use traditional paper. But I do like the online a little bit more, or something that you could store digitally. That way, in case you have something, a flood, a fire, or something happens, you always would have a backup in the cloud. All right, and if we could go to the next slide, Claire. Okay, so tracking expenses continued. We use that for profit and loss statements from Excel or other softwares. So it's a good idea to kind of really line that up so that it lines up well with your software, and also it's a smooth transition from your profit loss onto your tax forms. You're going to use your profit and loss statement to prepare a Schedule C, which is what sole proprietors use. And if you would also use profit and loss to prepare your statements for if you're an LLC or even an S Corp. Okay, so next slide, please. Okay, so let's look at what is income versus taxable income. So we'll read the definition here according to the IRS. Income, as defined by Section 61A of the IRC, gross income as income from whatever source is derived, including but not limited to compensation for services, including fees, commissions, fringe benefits, and similar items. What's all that mean? Basically, everything you bring in your business is income, unless the IRS has a specific loophole that says it's not. So all revenue, cash received, or bartered services from exchanges of products and services. That's taxable income. Taxable income is sales revenue minus your allowable expenses. And next slide. So business expenses. The IRS defines that as items that are both ordinary and necessary. So ordinary expenses is one that's common to your industry. Necessary expenses is one that is helpful and appropriate for your trade. So with ordinary expenses common to your industry, you pretty much would know what that is. But it must be necessary to do business in there, or the IRS could potentially question whether or not that's an expense that should be deducted against your income. Okay, next slide, Claire. Okay, so tracking your business expenses. This is really important because like I say, I prepare income taxes for people. I have a lot of my clients that come in at the end of the year, and they wait till the end of the year to try to gather up all their receipts. I know they're missing probably 15-20% of the receipts, which, depending upon how they track their expenses, they may not even know how many expenses they actually had, and then they'll be overstating their income. So it's important to track that. And how I like to track that is, the use of software. We live in the technical age, so why not, use that to our advantage? There's a lot of business apps that are easy to track your expenses. and the technology that makes your tracking of expenses easy. Like, for example, if you travel a lot for your business, mileage in your vehicle you're driving for business is a big expense that you should be tracking. And the IRS has a policy on that. They say that you must track your expenses, you must write down what they're for, and track your odometer readings. Well, that gets kind of detailed. And if you're running behind, are you going to sit there before you start and leave your office or leave your home office? Are you going to write down the odometer reading when you leave your house or your office and write down when you return? Most people aren't as disciplined as that. So the IRS says, okay, we'll be able to recreate that. So I like to use the technology. There's some apps that you can buy for $10 for the year that you track your mileage through GPS. And all you got to do is when you're getting on the road, you hit the app and start tracking your mileage. It gives you a timestamp, a date, and a third-party verification. In case you ever get audited by the IRS, you actually have third-party proof of your tracking of your mileage expense. So just to use that for example, that's it's good to use your tracking. It's good to use the technology. And if you're using QuickBooks Online, they have all these add-on apps that you can actually track. You can send invoices right there in front of your client or your customer. So there's a lot of benefits for doing that. And so I believe it's worth actually getting past the learning curve of actually learning the software. If we could go to the next slide. Okay, compiling your business expenses. Almost all of these softwares are going to have a profit and loss that you want to categorize your expenses to, so that they fall into expense categories that will match up, easily to your Schedule C tax form. You have a cost of goods sold or versus other business expenses, and the importance of doing this is consistency from year to year. One of the biggest things that I think sets off an alert for an audit from the IRS or from the state taxing authority is inconsistencies. So let's say you, for example, claim one year, something in office expenses that's $5,000, and the next year you have $200 in office expenses, but you had almost that basic same expense, but then you put it into supplies. And then your supplies went way up one year, and when they were 200 the previous year, there's inconsistencies there that set off computer programs that state, hey, this is raising a red flag for this client. Maybe we need to hand this off to somebody in our audit department to take a further look at this to see if we should schedule an audit. So consistency is one of the things that I recommend to all my clients, to be consistent from year to year, and using these profit and loss to categorize your expenses. Using those accounts really helps with consistency, and it helps with your tracking, and it helps you let you know specifically where you're spending your money. And it also could be used to find out whether or not we need to spend a little less there to increase our profits. So let's go to the next slide. The cost of goods sold. Okay, so what is cost of goods sold? Basically, it's a direct cost that can be directly linked to the product that is to the actual producing of the physical product, such as raw materials or the direct cost of labor. It excludes the indirect expenses such as overhead and sales costs. So categorizing these correctly helps for several reasons. Again, it goes back to look at your profit and loss. How much are we spending to produce our product? You want to look at those to find out where you can cut waste to increase your profit margins. So I think if we go to the next slide, we can look at indirect expenses, I believe. Yes. So indirect expenses, what are those? When I say overhead, there's some examples here, like rent. Rent will be the same price usually whether you produce one piece of a product or whether you produce 1,000. So it's hard to assign the cost of rent to each product. So we put those into an indirect cost. And when you're tracking these, you're going to want to put them into something called rent if you're using it for rent. And again, office equipment, utilities, phone, mileage, sales cost, advertising, supplies, things that are not directly related to production of your product. So those are considered other costs or indirect costs. We want to move to the next slide, Claire. Okay, so when we look at the expenses, we want to capture everything that we spend money on that we think is related to the cost of doing business. IRS now doesn't always agree with us. Like, for example, food costs. You ought to track your food costs if say you're buying lunch or something for a client. If that's deemed necessary for the business transaction, there's a deduction of 50% that you could receive on that. And sometimes it even can be 100%, but you need to be specific with that, and that's something you want to check with your tax planner or your tax preparer. So the 50% versus 80%. 80% is if you're an over the road, or you're in the transportation business, the IRS allows you to deduct 80% of your food cost. If you travel more than about 50 miles from your office or your home in a day, you can deduct 50% of your personal food costs. And I believe the theory behind that is you could eat for 50% less cost at home versus eating on the road at a restaurant. So you kind of want to find out and talk to your tax planner about that, about where should I be tracking? What's the best way to track this? Do I need to actually keep receipts for these? Or can I use what's called a per diem? There's a per diem, and there's kind of a national traveling per diem is $66 per day, full day of traveling inside the continental United States. I'm sorry, I've got that backwards. I think it's either $66 or $71. There's two different rates there, one for inside the continental United States and one for outside of it. But sometimes those are easier just to track the days that I was gone instead of keeping all the receipts. So you'll have to see whether or not it makes more sense for you to track the receipts. If they go over the $66 allotment of a per diem per day, then we want to do actual receipts. So another part, partially deductible expenses, is gifts. You need to look and see what the IRS allows you to give in gifts. Entertainment costs for prospective clients is another one that kind of waves a red flag with the IRS. If you're buying, say you're a big Giants fan and you decide to buy season tickets for your business, you need to actually figure out whether or not that's an actual business expense or not. And in the last couple of years, the IRS really looked at that category and said, we don't think that's a legitimate business expense. So you need to find out the ins and outs of whether or not you can deduct that. So you're not getting yourself into trouble with the IRS, receiving an audit, and then potentially being fined for it and being charged interest. By the time the IRS really looks at these expenses or to audit you, it's usually 2.5, 3 years down the road. So that time you have 25% penalties and about another 15% in interest on that. So you want to pay attention to that, because if you're deducting something that's not a allowable expense, that could cost you an additional 40% or upwards of close to 40% in fines and penalties. And then another expense that it's not something you actually write a check for, is depreciation. Depreciation comes in many forms, especially since here recently in the last 10 years, they have bonus depreciations. They have different types of depreciations for new products you buy, used products that you place in the service. So those are things that you want to look into and not make sure you don't forget about depreciation. Because whether you take it or not, and if you have a depreciable asset used in your business, if the IRS audits you, they're going to say, well, you were supposed to be taking this depreciation, and if you sell that piece of equipment, and you bought it, say, for $5,000, and you didn't depreciate $3,000 over a couple of years, the IRS is that you sold, let's say you sold that for $5,000 also. The IRS is going to say you actually had, because you're supposed to depreciate $3,000 out of that, you're going to have a $3,000 gain that you need to pay tax on. So don't miss out on your depreciation that you could have depreciated that over, say $1,000 a year there against your other income. So those are things to be thinking about and keep in the back of your mind when you're preparing your profit and loss. So, and if we could move to the next slide, Claire. Okay, so non-deductible expenditures. Most people know that this is probably not an expense, but just for clarification, non-deductible expenditures are bribes. Now, if you're doing business in China, there's actual clause in one of the U.S. laws that says if you bribe an official in China, it has to be above the lowest level of officials there, and if you do that, you can actually deduct that. But I am definitely going to encourage you to check with your tax professional on that one. Most lobbying costs are no longer deductible. Penalties and fines, those are not deductible. So if you pay penalties and fines, going back to that last slide, that where we had potentially a 40% of penalties and fines, those are not deductible. In the years that you pay those, you can deduct the cost of taxes in certain situations, but not the penalties or the fines. So again, we want to definitely take a look at that. Political contributions, those are non-deductible expenses. I think there's a caveat that allows you to do that if you're one of the large political contributions, only if your person gets elected and that actually has an effect in changing the way things are done. But for the most part, non-deductible expenses are included on those 4 items there, and there may be other expenses also. So Claire, if we could go to the next slide. Okay. So tracking your expenses to maximize your gross income and minimize your taxable business income. What we want to do is we want to make sure that we take advantage of all the loophole and all the deductions. So that comes in play with planning, and also when you have your taxes prepared, you want to make sure if you're preparing your own taxes, you want to know what the loopholes are, what the deductions you're allowed to deduct. If not, you want to make sure your tax professional knows that. So make sure you use a reputable firm and somebody that knows what they're actually talking about and knows how to actually look into all the new deductions. Like, for example, this year, there's a lot of new business tax credits that you should really be making sure you take advantage of that, especially if you had employees. There's employee credits for paying certain payrolls. And then also look into ways to defer taxes. 401k plans and other tax deferral plans. That's probably more for you as owners. You wanted to look into that, but you also want to look into that for your employees, because that's also a good way to retain your employees, and that helps minimize your cost of retraining a new employee by keeping the ones you have now that that can get along with all the rest of your employees, and also that they're competent and they can perform the job duties that you pay them for. So let's go to the next slide. All right. So in conclusion here, tracking your expenses with software, phone apps is a really easy way to do things. It's third-party proof. It's also time-stamped. So if you do, misplace your paper expense, your paper receipt, sometimes you get a good auditor. They're going to say, okay, you've got the majority of them here, but here's where you track your expenses. You have proof that you did it as time-stamped. Maybe we'll go ahead and give you the other 15% that you're missing receipts. Not always guaranteed, but at least you have a chance at that if you're missing your paper receipts or the equivalent of the paper receipt. You want to run your profit and loss monthly, but at a minimum quarterly, because that helps you with your tax planning. That helps you know, how much do I need to be putting away for my taxes? If you've been in business for a while, you realize you've got to pay quarterly taxes. And if you don't, the fines keep going up higher and higher every year. And then at the end of the year, if you haven't put enough money away or haven't saved for your taxes, it's going to be hard to come up with all that money for a whole year worth of taxes come tax time. So then again, you're going to get into the 25% penalty for not paying your taxes on time, plus the penalties and interest while you're in a payment plan. So it's very important to know how much you're going to make throughout the year, and quarterly is at a minimum is what I recommend. And that way you know how much you need to be paying to the IRS and to the state taxing authorities on deposit for your taxes when they come due by April 15th or July 15th, as in it was last year. To pay your taxes on time. That will help keep your profit margins higher. Plus, it'll keep you out of hot water with the IRS. I do recommend you sit down with your tax specialist a few times a year. I know with the pandemic and everything, doing that in person is probably harder this year, and will probably be harder going forward. But thank God we have all this technology. We got Zoom. You can do FaceTime, but actually contact them. And though most of your tax professionals have no problem sitting down with you when it's not tax season, because the tax season is their busiest time of year. But they like to have you set up so, one, you succeed. Two, it makes their job easier at come tax time also. So do that several times a year. Don't be afraid to call them. Also, when you do talk to them, look for strategies to avoid or defer paying taxes. Look for credits to take advantage of. Take a look at the tax laws and the loopholes that get put out there. Like, for example, the last tax plan was a temporary one. I think it only goes through the 2026. So when 2027 comes along, well, everything's going to change. So you want to be informed about what's going to change so that you, during 2026, adjust your business strategy so that you take advantage of those loopholes throughout the whole year instead of not missing that year with the loopholes. And definitely, since it looks like there's going to be new tax laws changed, we want to be on top of that, and we want to make sure that we know and take advantage of those. This is one of the things I tell a lot of my clients. If you're good at what you're doing, making money is easy. Keeping it is always the challenge. So I always encourage you to pay what you're supposed to pay to the IRS and to the state taxing authorities, but don't pay them a penny more. It's your money. You worked hard for it. So let's figure out ways to keep the majority of that. So that's kind of what I wanted to touch on today. Now, if you are not proficient in the software, I would encourage you to contact Clara there, and she was going to direct you to the QuickBooks teachers, the people that know and teach these softwares. I think actually later today there may even be a seminar that they're giving on Excel. So I would encourage you to pay attention and stick around for that. If you don't know how to use the softwares, that would be a good start, and it's no cost to you. So, all right. I think I want to open this up for any questions at this point.
Sounds great. Just to FYI, I got a comment in the chat box that I accidentally sent the link to the same workshop. So while Joe is answering some questions, I will remedy that. Apologies. We do have a couple of questions. I saw a few questions in the chat box, but I want to first go over to the Q&A. And I really do want to encourage folks to put questions in the Q&A, just because it'll make it a lot easier for me to find the questions so we can get Joe to answer the questions. So first question I see in the Q&A is from Logan. Are startup expenses tax deductible in the first year?
Yes and no. It depends upon the type of expense. And again, this is everybody's tax situation is unique to them. But startup expenses can range from research and development, even in a different market. Now, the IRS the previous ruling on that is if you have started expenses for research and development to make sure that that's a market you want to be in, you can expense those in the year that you actually start practicing in that market. But you have to actually practice in that market. So if you're looking at, let's say you wanted to move or branch out, let's say you're a retail store and you wanted to branch out into, say, Chico, but you're not quite sure and you want to go there. So you want to go travel there, spend a couple of days there talking to local businessmen, maybe checking out your competition. So your travel time there, if you flew there, then your flights, if you drive, your mileage, your food per diems, those are all deductible only if you open operations in the location that you're looking at. So those are some of the things that could or could not be. If you bought some equipment, let's say you started a construction business and you bought a backhoe, you could buy that in, say, 2020 in December, but you didn't open your business until January 2021, you would probably deduct that in 2021. But if it was a brand new backhoe, you may be able to deduct the full cost of that. But if it was a used backhoe you purchased but placed it into service, you could deduct, I think, about 50% of that, and then you'll depreciate the rest of that equipment throughout the next, 5 to 7 years or whatever the life of that asset is. So it's not an actual, I can't just give you a yes or no on those answers, but I would encourage you to look at anything you're spending that you think is related to your business, to make note of it and talk to a tax professional about that to see if you actually can deduct that.
Great, thank you. Just jumping right into the next question from Stephanie. For a single member LLC, what is the difference between the LLC fee and the LLC tax? What are other state and local taxes? What are other state and local taxes do?
Okay, so the Franchise Tax Board in California, and almost every state has something similar to that. However, California is probably the most expensive state to do business in. They charge a minimum of $800 for a franchise tax fee. And then it goes on a percentage of your, I think it's either sales or your net income. So there's a percentage there. That's an actual fee. They do kind of call it a tax, but that is potentially deductible. And that's a fee that goes with LLCs, and it doesn't matter if you're a single member, if you're an LLC being treated as an S Corp, S Corp or C Corp. They actually charge that to everybody but sole proprietors. Even though the single member looks more like a sole proprietor, you do have to pay that fee because you are an LLC and you enjoy the benefits of the limited liability of the corporation versus personal asset protection. So, that is something that you definitely have to pay. And it is, like I said, may be deductible, and check with your tax planner on that.
Wonderful, thank you. Next question in the Q&A, and then I'm going to look for questions in the chat box. So again, just to encourage folks who do have questions, please put those in the Q&A so we can make sure to get them answered before we finish up today's session. The question from Anna, can you give us some examples of tax loopholes?
Okay, so when I say loopholes, there's all kinds of different ways to defer taxes. And also like depreciation. That's kind of a tax loophole because not everybody knows to take advantage of it. You could or could not take advantage of it. I always encourage you to expense everything you possibly can before you depreciate it. And with different administrations, they have different beliefs on what they should give us breaks on. And so tax loophole basically is a way to defer taxes, or we're not paying it all altogether. Like, for example, a tax loophole is on your food. We all have to eat, whether we're in business or not. A tax loophole allows you to deduct 50% of your food cost if you're traveling. That's an example of a loophole. um, stuff like that. 401k plans, IRAs, they allow you to defer your taxes. If let's say you're a real estate professional where you buy property and you turn them into rentals, and that is your livelihood. You actually do that for a living, and that's the only thing you do. And you decide to sell your property after you had it for 5 or 7 years. You found another property that's better. You can take advantage of what's called a 1031 exchange. That allows you to exchange the basis, meaning the cost value of your property. You can exchange it to the next property and not pay the capital gains tax on it. So, for example, on that scenario, let's say you bought a house for $100,000 and you depreciated over the 5 years, depreciated $20,000 out of that. Now your cost basis is $80,000 on that house, not $100,000. So if you sold that property for $200,000, you would have to pay capital gains tax on $120,000. Now, if you do a 1031 exchange and exchange the full value of the property, you sold it for $200,000 and you bought another property for say $200,000 or greater, you would not have to pay the taxes, the capital gains taxes at this moment. You would have to pay them when you sell that other property or defer it again to the next property. If you sell that property and do another 1031 exchange. So there's different tax loopholes in the tax code that allow you to do certain things like that. I kind of hope that answers your question. I know there's a lot of scenarios there. And really your tax professionals are the ones you want to look into that, especially this year. Look at all the tax credits you have, especially if you employed people. You want to look into, the PPP loans if you took advantage of those. They now just changed and made a tax loophole on that one where any of the income that you received for it that's forgiven is not considered taxable income. But you're allowed to actually deduct the expenses now. Whereas the IRS said if it was forgiven, you weren't going to be allowed to deduct the expenses on anything that you spent that money that you were given and forgiven on. But they changed their mind on that in December. It was December 28th. It came out with a new ruling that says, one, you're not going to, the income that you receive from the forgiveness on the PPP loan that you received is not going to be considered revenue. You won't put that into the revenue column on your profit and loss. It won't be considered income on or revenue, there's sales revenue on your taxes, but the expenses that you spent with that will be deductible expenses against whatever revenue that you had outside the PPP loan forgiveness. So there's another loophole that just came out a couple weeks ago. I know a lot of people don't know about that, and there's a lot of tax professionals that don't know about that. I personally didn't know about that before I read it either, but it was because I actually went ahead and started looking into this because this is something I want to be informed and I want to be able to do a good job for my clients also. So that's the reason I went back, about 15 minutes ago. I was talking about make sure you got a good tax professional, or if you're preparing your own taxes, you need to do some research on these new tax loopholes.
Definitely keeping us on our toes.
Yeah. So it's good for me because when these changes come along, less and less people prepare their own taxes. So they call people like me.
Good for business. Keep it confusing.
Yeah.
Well, great. Thank you for answering that question so fully. We have a couple more questions, and we've got a bit of time. One question from the chat box I see is, do you have any apps that you recommend for mileage tracking?
The one I like to recommend mostly is Mileage IQ. That's a relatively cheap app that you can put on iPhones or Androids. And like I say, it's really cheap to use it. It's easy. You basically hit it like any other app. It opens up and then you hit go. So that's one of the apps that you can use with that. And then there's all kinds of different apps that go along with like QuickBooks. Like if you want to do your own payroll, you can add that on. And it basically calculates it for you. It's kind of a plug and play type thing. You put in the information and it spits out the the correct taxes that need to be taken out for your employees. And you can run payroll.
Perfect.
There's just a lot of different apps that you can add on to QuickBooks, like, sales receipts, that get a little more in depth than what the basics. There's just a lot of apps you can use.
Mm-hmm. Thank you for the recommendation. We have a question in the Q&A from Logan. In a multiple member partnership, 2 members, how do you file taxes individually? Do we separately have to file a Schedule C form?
Okay, so if you're in a partnership or LLP, multiple member LLC, there is a form that distributes the income because it is a pass-through entity. It distributes it usually on a K1, which is another tax form that the entity, the LLC entity, prepares based on percentage of revenue and percentage of expenses. And then it goes in different categories. Like depreciation, there's certain limitations that you can deduct on your personal taxes, and a lot of it has to do with how much you actually make on your total personal income. But the K1 is it distributes the income, and sometimes it goes to a Schedule E. Other times it goes straight into other income on your tax forms, and then sometimes it'll go into. It depends upon how you're set up. So it can go on to a Schedule C. So there are so many versions of an LLC out there. Again, I encourage you to talk with your tax professional on that, or really sit down and understand it, because there are a lot of benefits to an LLC that is taxed as an S corp. I won't get into all of them, but if you're got an LLC and you make $30,000 a year at it, you're probably just going to be paying yourself a wage with that, because you probably are the only one in there and you actively participate in that. Now, let's say you have an LLC or you're a shareholder of an LLC or a partner and you're the one that put the money up, but you don't actively participate in it. It's more of an investment for you. That is going to distribute your income as an investment income. So you pay ordinary tax on that and you don't pay the self-employment tax. So there's a lot of ways to set that up. And then there's some people that actually fully participate in their LLC, but they're also an investor in there also. So a lot of places, a lot of CPAs will actually recommend that you pay yourself a W-2 through that and pay yourself a customary wage for that industry. And then the difference of that you pay yourself as an ordinary income is a way to not pay as much business. I call it business tax. It's the 15.3% tax that you pay for self-employment income. And so a lot of places, if they're starting to make $200,000, $300,000, will pay themselves $50,000 through a W-2, and the difference they will pay as ordinary income. So it does start adding up there. If you had $100,000 ordinary income and you didn't pay the 15.3% self-employment tax, that's $15,300 in taxes you avoided because of the structure of your LLC.
Important information to stay on top of. Mm-hmm. Great, thank you. A couple more questions. There was a question in the chat box about how folks can get in touch with you. And just to let everyone know, I will be including Joe's email in my post-workshop email that I'll be sending out in the next couple of days with the link to this recording as well as a copy of slide deck. So if you want to reach out to Joe and get Joe's help with your taxes, because he seems to be the man to call, you will be able to get in contact, and I'll be giving his contact information to you. We've got another question in the Q&A. This question asks, when are you allowed to file taxes annually versus quarterly, state and Fed?
Okay, so your taxes, your quarterly taxes are due, I think it starts January 15th, April 15th, June 15th, September 15th is the cycle. They must be in by that date or postmarked for your quarterly taxes to avoid the interim penalties if you underestimate what you're going to owe at the end of the year. Those are the dates for the quarterly taxes that owners have to pay. Now, if you're actually talking about payroll taxes, Those go either quarterly and sometimes they go monthly, depending upon how much you actually have. I think there's a threshold there. And so those are the taxes you do there. And then majority of businesses work on a fiscal calendar, fiscal year. So your year goes from January 1 through December 31st, and then your taxes on it in a normal year is due on April 15th. But like last year, we saw they extended that date till the July 15th for personal taxes and June 15th for your corporate taxes. For LLCs and S corps all have to be in 1 month in advance of your personal taxes. And the official ruling on that is it has to be after the third month after, on the 15th day of the third month after the end of your fiscal year. So some businesses will actually run from, say, September is the beginning of the year and ends on August 31st. Those are more, you see a lot more of those with the C corporations. But you can designate a certain fiscal year with your taxes. And again, that gets into strategy and planning as to why would you do that. Most businesses are on a calendar year. So corporate taxes, LLC forms are due in March 15th in a normal year, and your personals are due, of course, on April 15th. And if you don't send in your corporate taxes, LLC, if those are not in by March 15th, for every member, it's about a $150 fine per month per member that you don't have that in. So that can add up and take away from your profit margin.
Good to be aware of. Thank you. We've got another question, which I believe we've got time for, if I may.
Sure.
This question is from Anna. Do you think that there's any chance the IRS will delay tax deadline to July in 2021?
The answer to that is right now, April 15th is the date. However, my personal feeling is I'm going to plan for April 15th, but I really think they're going to extend it again this year because it doesn't look like COVID's going away anytime soon. I think we're at a minimum August is before they're going to really start opening things up. And that's if everything goes as according to plan. I've been hearing reports that in London and other countries, the virus is mutating. And if it mutates like viruses can do, that could prolong this. And, who knows how long we could be in this situation. So if that's the case and the IRS stays shut down, or to a limited staff like they went through last year, they're going to have to extend it. But I'm going to tell you, don't plan on that. Always plan on any business. You always plan for the worst case scenario, and there won't be any surprises. If you plan for the best case scenario, there's going to be some surprises.
And the benefit is the taxes will be done. So
yeah, I mean,
go off your plate.
Yeah, I think the IRS this year actually is officially going to open for filing taxes at probably around the 27th of this year, of this month. I'm sorry. Like places like Jackson Hewitt's, they always do the test of the guinea pigs for the new system every year, so they open up about a week in advance. But most business owners haven't compiled all their tax information, and most of them, the ones that are ahead of the game, usually start planning and getting their taxes done, usually in the first part of February.
Time to get prepared.
Yeah.
Well, great. I don't see any other questions in the chat box or in the Q&A. So if there are any questions, again, you will receive Joe's email, so you'll be able to follow up with any questions that you might have for him. In the meantime, while folks are filling them out, Joe, I want to say a big thank you for coming on with us today and answering all their questions really clearly, illustrating and laying out what we can do to get our business taxes prepared. So thank you.
It was my pleasure.
And you'll be doing this again with us next month, twice, I believe. So if anyone wants to come back, ask any new questions, check the West Business Development Center workshop schedule. You'll see in February, near the end of the month, we have 2 more tax prep workshops. So you can join us again, since this was so much fun. It really was. I've never felt more confident about my taxes, and this is coming from the person who tearfully calls my father every year saying, "Dad, I can't do this. I can't do this." He's like, "No, yes, you can. Yes, you can." So thank you for making us feel a little bit better and like we've got this. Really appreciate that.
Yeah, I definitely want to encourage you to reach out to the West Center and the SBDC. There was a lot of free resources, and the people that they bring out alongside them really are professionals in their market. And it's business is tough enough right now with this pandemic. Um, Take advantage of all the free good advice you can get. So I'm going to leave you with that, and thank you for joining us today.
Yes, thank you all so much. I'm going to go ahead and in the poll, again, keep your eye on your inbox for the emails that'll have all the useful information. And I do want to just quickly shout out that if you aren't in Mendocino or Lake County, call the West Business Development Center anyway. We will help put you in touch with your local center, wherever that may be. There are centers all across the continental US, both SBDCs and WBCs. We all are working together for the small business owners and entrepreneurs. So let us know what we can do to help you. So thanks all for coming. Have a great rest of your day and look forward to seeing you at one of our next workshops. Take care. Bye.
Bye-bye.